Mortgages are very much related to loans. So it's basically a loan just on a bigger scale, okay? So we're gonna understand mortgages at the end of this. Some key terms here. Oh, let's put under, right beside mortgages, it's a loan towards real estate. Real estate could also be just a property. You could just own a piece of land if you wanted to. So there's mortgages, a loan to purchase real estate. Amortization period is the length of time. Most mortgages are amortized over 25 years. Obviously, if you sign for a 5-year term, when the 5 years are over, your amortization will be 20. And then 5 years are over, now your amortization will be 15, right? It goes down over time. However, a lot of people, they go 25 years, all right? 5 years are over, they reset the clock. Let's do 25 years from now, right? And why do they do that? Because their payments go down, but you pay way more interest in the long run, okay? Equity. You should already know what equity is. The portion of the value of your property that you own. Interest is also known as the finance charge. We call this the total interest paid. Principal is the amount you borrowed, also called the mortgage amount. Unpaid balance is the portion of the value of your property that is owed to the financial institution. This is important. This gets a different color. I will ask you this from time to time. Your down payment in Canada, you can choose how much you want to put down, but the minimum amount is 5% in Canada. You have to have a 5% down payment. The amount after the down payment is then mortgaged or financed. Okay? Continuing. You buy a house worth $200,000, and let's say you make a down payment of 25%. How much is your mortgage in this scenario? Well, you go 200,000 minus 25,000. I used easy round numbers. Okay? Your mortgage in this scenario would be 175. Okay? What is your equity in the property at the very beginning? At the very beginning, it is simply the 25,000 you've put down. So in this scenario, your equity at the start would be 25,000. Right? Let me highlight that. Your down payment, in this case, is your equity, but not always. As time goes by, it's going to grow. Okay? What is your unpaid balance at the very beginning? It's 175,000. Decreases over time. And I will put next to equity, increases over time. And you also need to know how to do this one. Calculate the down payment as a percent. So in this case, if you put 25,000 down on this house, what is it as a percent? And I'll give you a formula there. Down payment, if you want it as a percentage, you put your you take your down payment in dollars, you divide it by total, also in dollars, and then you multiply your answer by 100. So that is the formula to figure out the down payment as a percent. So sometimes a province will ask you, hey, how much has this person saved up, percentage-wise? So in this case, it would be 25,000 divided by the 200,000. We multiply that by 100. So you go 25K divided by 200. It's 12.5%, right? If you multiply that by 100, 12.5%. It would be wise to go 12.50, but because it's not a dollar amount, we're fine to just state it as 12.5. Okay. So saved up more than enough. Okay. Here you go. If you, I talked about this already. More types of mortgages. You can have a fixed rate or a variable rate. If you go fixed, the interest rate, a mortgage rate with the interest rate unchanged for a specified period of time. Variable rate, the mortgage rate may change from month to month. Okay. May change from month to month. And this is old already. Just a couple of years, but there was a time, look at the 5-year here, and you compare to these financial institutions. By the way, you don't have to go to a bank to get your mortgage. You can go online these days, okay? So there's brokers online. There's brokers just in general. These are companies that have access to many different rates all over the country. You can have someone in Vancouver sign, like give you a deal for your mortgage. Not a big deal, okay? Just make sure they're reputable and you check, make sure it's actually like a legit site. Like don't just go with whatever, the first thing that pops online, okay? But there's closed and open or fixed variable. They mean about the same thing, okay? Let's keep going. You don't need to worry about that in general. I want you to skip 19, go to 20. Page 20 looks like this. I want you to notice this, okay? Pay attention to this part. These formulas are identical to the ones used in vehicle finance. So if you're running a little bit tight in space, on space, I should say, then maybe double up. But I would, for now, say let's have these separately on our study sheets. Okay, so these are the formulas that you're expected to know. Okay. And maybe I will customize these a little bit. So some students have a hard time with this. So the table rate should be in brackets like this. Remember that if there's a down payment, which there should always be a down payment when it comes to a house, but for some reason the province has had questions without a down payment. But if there is one, right, if you subtract the price of the house minus the down payment, that is what we call the mortgage, right? That's how much you're borrowing. You can go /loan here. So on your study sheet, if you go to vehicle finance, this is what we call the loan. Now we just have a different name, but they mean the same thing. We're borrowing money, right? If you want to know interest paid on the first month, this is key. The question will say, how much interest have you paid on the first month? Then you need to take this part. So I will use highlighter here. You take the mortgage here, like after subtracting, that number is what you plug in there. And then you multiply it by the interest rate. Interest rate, not table rate. These are not the same. Interest rate will be a percentage. Okay? That's why we divide by 100. The table rate is how much the bank charges you per $1,000. That's why it's divided by 1,000. First month's principal, how much you've paid principal. So to get that principal, you go monthly payment minus the interest. So it's basically these two being subtracted here, right? You can say this, PMT minus I. That's really what's happening here. Same thing. Please don't just have this. Tell yourself what does this mean. Total paid to the bank is a payment that you figured out times 12 months, because we always calculate monthly payments in this course, and then multiply it by the number of years. Total interest paid, so total interest paid, we repeat the total that we've paid to the bank, but watch this. I'm going to use the same highlighter I used for mortgage up here. I'm going to do that here. Honestly, guys, just copy these onto your study sheet. That's as easy as that, okay? If they ever ask you, how much has a person paid for the house? Like, you're done paying off your house, how much did it really cost you? How much did it really cost you? Well, guess what? You take how much you paid to the bank, right? So this part right here is paid to bank. This will have interest and the amount that they borrowed you plus the interest included. You have to add the down payment on top of that. That's when you can say, at the end of the day, this is how much the house has actually cost me, okay? So these are the formulas that I can think of that you're going to need for home finance when it comes to loans and mortgages, okay? Okay, we're going to skip some of that stuff that comes next. I will take an opportunity later on to talk about that a little bit more. I just want you to see this table right here, just for reference, okay? So let's say your mortgage is $345,000. That's how much you're borrowing. Same interest rate, same term, but watch what happens to the amortization. Like, this is what I want you to check out. The amortization, like the time it takes you to pay off. Here it would take you 25 years to pay this off, this house. Here it's 19 years and 4 months. So you shave off 5.5 years or more, actually. How did you accomplish that? This is what happened. This is the part that made the difference. You made an additional You made an additional $288 a month payment under these circumstances, okay? And so you shaved off 5 years, okay? Savings, 5 years approximately, right? Approximately. Look at how much interest you've saved to go from one to the other. So you've saved in 5 years just for that. For the term, for the 5-year term, if you subtract this, you will have saved, no, let's focus on this one, total interest. The total interest saved, I'm going to put an arrow to this one here. Total interest saved, look at that. That's approximately $75,000. No, this is exact, actually. You making an additional payment of $288 a month will end up saving you guys, saving you $75,000. Okay? So it's quite powerful to do that, okay? So adding or increasing your payment will obviously save you an interest in the long term. So let's do some math here. On page 22. But before we do this, I'm going to ask you to take your study sheet. I don't know if you have a study sheet. And I want you to copy those formulas onto this study sheet, okay? So I'm going to do that right now. I'm going to ask you to do that so we can constantly come back to this. So I'll call this home finance, right? Let's just call this mortgages. I will add extra stuff to this. So if you want extras, make sure you copy this down, right? Mortgages. Here are the formulas. I will change it up a little bit. Monthly payment is going to be price of the house minus down table rate divided by 1,000. So you don't have an excuse, really. If you don't copy this down, that's on you, okay? This is what we call a mortgage. I'm going to use a different color for this. Okay, that's the mortgage or loan. This table rate, table may be given. Okay, so it'll be like 508 per $1,000 of loan. Right? So then you take the 508 and just plug it in there. And next we have interest paid. I call this total interest paid. Or did I do first month? I did first month. Okay. This one is more popular, so I'll just do this one first. Total interest paid. You take your payment. Okay, you multiply that by 12 months. You multiply it by the number of years. Minus the mortgage, and I'm going to use red for that. Interest paid first month. It's a little crowded. You take your mortgage. You take your mortgage. You multiply it by the interest rate. It's going to be a percentage divided by 100. And then you divide it by 12. Principal, first month is going to be your payment minus interest on the first month. And the formula is half the battle, right? Sorry, and I'm gonna shorten this one. Total interest. It's gonna be hard to get this in without making it look crowded, but this is total paid to the bank. I will just redo that here. Total paid to bank is payment times 12 times years. Okay? total paid for house is payment times 12 times years plus down. Should be copying this, okay? And then I'm going to get rid of this study sheet thing here. The down payment as a percentage, you're going to go down in dollars divided by total times 100. And this is the bonus part right here. To save interest, increase down payment, make additional payments, shorten amortization, shop for a lower interest rate, I know it's crowded there. You kind of have to decipher that. On top of that, I apologize that I have never had to make my own study sheet, but I would white this out. I don't know. It's just waste of space. To lower payment, let's say you just want to get a smaller payment. You don't want to have the payment is too much. You're trying to find ways to lower the payment. How would you do that? You can still increase the down, okay? I'll just do that. You can lengthen amortization. You can say just take longer, take more time to pay it off. You don't have to use these fancy terms. Shop for a lower interest rate. That does it, okay? I think this is worth your time to do this. Okay? These are formulas that you will encounter all the time, okay, in this unit and for the rest of the course.